Our panel of personal finance pros are here to tell you how to avoid some of the short-term setbacks to achieve your bigger, longer-term goals. Very pleased to welcome here in the studio with us today Gemma Dale from nabtrade, Sarah King from Stockpot, and of course my guest host Adam Dawes from Shaw & Partners. Great topic for conversation today, and pleasure to have you both on board. Sarah, perhaps we can start it off with you, because this seems to be the question at the moment. Do you save or do you invest? Let's start off with the difference, really. Your thoughts?
Yeah, certainly. So the key thing here is time frame. So when you're looking to save, it's really sort of to fund your shorter term goals. So anywhere between 3 months to 3 years, and you're usually saving to fund some lifestyle expenses. It could be saving for a home deposit, it could be saving for a wedding, something where you want to be sure that you're going to get that money back and you've earned a bit of interest along the way, and know that your money's quite secure. Compared to investing, that's for the longer term. And you might see yourself taking a little bit more risk because you're targeting higher potential returns. But really when it comes to investing, you're looking for that medium to long-term time frame.
Adam, your thoughts? I mean, I guess you put your money into a bank account at the moment, you start to save, and you're basically earning nothing from it, right?
Correct.
With these ultra low interest rates. Do you think it is better? Being a stockbroker, I probably can guess what you're going to say. Invest.
Look, certainly I think over time, it depends on how much money you've got saved up as well. Sometimes when people come to us and they say, I want to buy $200 worth of a stock, and they want to buy a CSL, and it's like, well, you're going to get one or two, it's not really worthwhile. So saving up, I guess, a little bit more of a lump sum, and then using that money then to go into the market or to invest, I think is the right way to do it. It does come around risk profile as well. So depending on where you are in your stage of life, if you're at retirement or in pension phase, maybe it's not the right thing for you, maybe saving that cash. But if you're in that growth or accumulation phase, then certainly getting that money working harder for you is better.
That's probably an important question as well. If you only have a small amount of money, perhaps investing in shares or investing elsewhere maybe is a deterrent if you only have a small amount. How should we think of it though if you have a small amount? Do you start saving or do you start investing?
I think it comes back to time frame and goals, right? So even if you only have a relatively small amount, so less than $1,000, you can start investing with very tiny amounts now. Things are so much cheaper and easier than they used to be. 20 years ago, if you wanted to start investing, you went to the white pages, you found a broker or a financial planner who could help you. You would be there for hours just trying to find a person who could help, and then when they did, you would pay for advice, and it was quite a complex process, right? It took a long time. Minimums were $5,000. Yeah, it was quite difficult, whereas now you can start trading online for $10 to $15. You can buy very small parcels of lots of different things. So if you've got a really long time frame and you know you're going to be adding to it, you may still want to think about investing. The critical thing is you don't want to be eating up your entire capital with fees or your brokerage cost or whatever.
Yes.
So you want to make sure that you're putting at least some of the money in the market. And if you are going to be growing it quite rapidly, then it's something that you can contemplate. But you've got to have the time frame, and you've got to have it for a meaningful goal.
Meaningful being how long?
So I would say 5 years minimum, and I think it's important when we look back over the last 10 years, you can give plenty of examples of things that seem like very high quality assets that have not delivered a high quality return over 5 years. So if you don't have 5 years, you would be thinking about saving over that period. Often use the example, we just upgraded our house and we weren't sure how long it was going to take. It took us 4 years in the end to choose the house that we wanted to upgrade into, and we were saving like mad that whole period. Had we been investing, that would have been a risk that we weren't comfortable taking, and we could have taken a capital loss in some of the things that we would have chosen over that period. It wasn't right. I would have preferred to upgrade a bit quicker than 4 years. That wasn't ideal in terms of time frame. But because we didn't know what the time frame was, saving was a smarter choice for us. We knew it was going to be medium.
It's the risk though, isn't it? It's the risk that you're not willing to take, and I think that's the key thing, is if you don't have that risk appetite, then keeping the money in the bank is probably a good thing.
It's a safe option, isn't it? Because you're investing, you have the risk of basically losing all of it.
Go to zero.
Yeah, exactly right. Sarah, what about when is a good time to save and perhaps when is a good time to invest? What would be your advice?
Yeah, so starting with investing, I mean, this is the $1 million question that we get asked all the time. Certainly I have clients ringing me up every day and saying, when should I invest? And I think when it comes to investing, we don't have a crystal ball, and we know that we don't know what markets are going to do tomorrow. So the best thing you can do is is just start. And, you know, it doesn't mean that you have to put all your money in on day one. You can use what we call a dollar cost averaging strategy, where you're drip feeding your money in smaller amounts over time, and that helps you avoid that fear of, you know, if the market were to drop tomorrow, that you might lose a substantial amount of your money. So, so when it comes to saving, a good time to save is when you've got a bit of surplus cash flow and, you know, you're wanting to start to make it work a bit for you. You can pop it into, or you can deposit it somewhere so it starts to earn a bit of interest.
Look, let's we might actually pick up a viewer email that's come in. I'd love to get your thoughts. So Chloe has written us an email saying, my savings seem to be lying idle in my bank account and the interest rate isn't great either, which is basically what we're discussing. Investing is finally on my radar. Where do I start? Gemma?
So, come back to the boring questions I've already asked a couple of times, which is what's your time frame and what's your risk profile. So the critical thing is, what are you comfortable investing in? What are the risks that you are willing to take? I think if you're starting from scratch and anxious, educating yourself is the very best way to minimise some of your anxiety. Rather than saying I should take less risk, make sure you understand what you're looking at. We're all big fans of the stock market on this table, so let's start there. You've got your major asset classes to look at. If you have a small amount of capital, property is out of your reach. And that's worth noting. Or alternatively, you take on an enormous amount of debt, which you then have to fund. So let's have a look at the stock market as a really good place to start. The critical things you should think about are diversification. So when you're first starting to invest, the safest way of ensuring that you're not taking too much risk is to have a bundle of assets rather than choosing one stock and hoping to hell that it goes really well. Choose a bundle of stocks across a lot of different sectors, for example, different areas that they're going to do well, preferably across different geographies as well. So not just Australia, then you have different sectors that are going to do well, different countries that are going to do well in your portfolio, and they will hedge you against the ones that may not do so well. So you get this average return rather than really big swings in your portfolio. But start small if you can, take your time, educate yourself about the different types of products that are available to you and the strategies that are available, and diversify to minimise your risk so that you have time to build up.
Adam, in your opinion, what are some good products for investing versus sort of putting it in the bank account?
Yeah, so there's certainly a lot of low cost, and I think that's the key, is that low cost, because people don't have so much money. But certainly there's alternatives out there for low costs. SMAs or managed accounts, so something that is managed for you or it's been looked after for you. Managed funds, certainly another area. There's some leverage products out there as well. There's quite some good ones there.
Sorry, do you lump ETFs into that? Because you have your managed funds and that is active versus passive.
Yeah, so I would, ETFs would be another category as far as investing in the diversification tool that you're talking about, that then allows you to have a basket of goods that you can then, and you can create good portfolios with good asset allocation inside an ETF with a low MER and a low transaction cost. So there's really no excuse for anybody not to be starting to look at investing in small amounts. Sure.
What would you advise, I guess, in terms of products, where to look for to invest, Sarah?
Yeah, so I mean, at StockSpot, we invest only into exchange-traded funds, so ETFs, and they are our product of choice because of those amazing diversification benefits, and they give you access to hundreds of different companies around the world, access to different regions, and they're very, very low-cost products. So, you know, our clients are getting exposure to not only the Australian share market, but global markets, bonds, as well as gold. So there's certainly a product that I would see or want to see people starting out in investing to use and get into.
Are ETFs better for the longer term as well, or is it something that you can kind of have a bit of a shorter term horizon on, given that it's, I guess, a little bit less risky, isn't it?
Sure. So look, again, it's investing, right? So I think you could certainly have a portfolio of ETFs that you may want to hold for 3 years, but you'd want to have a more defensive asset allocation. By that I mean you have more of your money in things like bonds and gold. So you could, you're really wanting to sort of target a 3-year minimum. If anyone comes to me and says that they're looking for a shorter time frame, I would probably say investing may not be for you. you, it's better to keep it in a high interest saver or some other product where you're going to get that stable income generation. And you know your money's going to be there when you want to withdraw it. Yeah.
Gemma, I wanted to ask you a question around tax, because this has come up a lot in conversation. Franking credits, we know that a lot of stocks here, the ASX versus other global markets, we are, have high-paying dividend stocks here, fully franked often. Changes in franking credits, it's come up a lot in conversation. Would you look at, say, tax benefits as a reason to invest in the stock market?
I think one of the biggest challenges for people who are saving and they have a savings goal is that you get effectively zero tax benefits from investing in cash. It's not investing, you're saving in cash, but you get zero tax benefits from it. So every dollar that you earn in interest is taxed at your personal marginal tax rate. That's not great fun, particularly if you're a high income earner. So it's difficult for young people who are saving quite hard to buy a home, for example, to build up any kind of meaningful savings because they're not getting any tax break at all on that stuff. There are much more generous tax concessions available to different types of investment. So we know we have negative gearing in this country, we have very strong dividend paying companies, and we have franking credits. So we know that there are, and we also have the capital gains tax discount. So there are very generous tax concessions for investment income relative to savings income, which make it really appealing. The critical thing I would say is legislation changes over time. That is the area that I've worked in most of my career. It changes, I made a job out of it, telling people how it works. Do not be investing purely for the tax benefit. There's a couple of risks with that. One is you haven't looked at the underlying quality of the asset as closely as perhaps you should have, and that's always dangerous. And secondly, if things change, you may find yourself in a difficult situation that you want to get out of. So it's lovely to get the tax benefits, but please look at the asset you're investing in and know that you would invest in it anyway. Even without those tax benefits, it stands up on its own 2 feet and you believe it's worth investing in, irrespective of those benefits.
Yes.
Because if things change, that's a decision you're going to have to look at.
Yeah, so underlying business really is what you need to be looking at, really solid management. Sarah, just before we wrap up, anything else that you would like to add, anything that we kind of haven't covered that would really be helpful for our viewers?
Yeah, so I think so if you're starting to invest, I think it's always helpful to have a few tips that might help get you started. So in my mind, if anyone comes to me and they're wanting to start investing, I mean, number one, always look at if you're carrying any high interest debt. So pay that down first, because the rates you're going to be paying on the high interest debt is going to far outweigh what you're going to earn investing in the short term. And then I would recommend always having a rainy day fund set aside. So we recommend that people have at least 3 to 6 months worth of their expenses set aside to cover any rainy day expenses before you start investing. And when you do invest, like similar to what we've heard, like do your research, make sure you have a really good asset allocation and a well-diversified portfolio that's giving you access to lots of different investments. So that's bonds, gold, shares, international shares, and then also look at the fees. So that's crucial. Paying low fees is really going to help you generate those long-term returns, and then it's all about staying invested. So stick with your strategy, stay in it for the long haul. The compounding of returns will kick in, and that's where the magic happens.
All right, fantastic. Look, it's always really, really critical to get back to basics and really understand saving versus investing. So great topic today. Big, big thank you to our guests who joined us, Sarah King from StockSpot. Thank you so much. And of course, Gemma Dale from nabtrade. Thank you.